All right. Good afternoon, ladies and gentlemen of the board. We are MBA Investment Bankers LLC. I'm Frank Russ. These are my colleagues, Josh Hostetler, Brad Newman, and Kaushik Saha. We understand this is an important time for Fastlane Incorporated, and we want to thank you for inviting us to come and present our analysis of your current situation regarding the recent offer by Autobahn AG for ownership buyout. For our presentation, we're going to start by highlighting some of the key points, some key industry factors, both in the U.S. and in Europe, as they're the most important that are going to affect Fastlane Inc.'s operations moving forward. We'll then move into three valuation approaches that we use to form a valuation portfolio for Fastlane Inc. These are going to include the EBITDA multiple, the blue sky method, which is largely used for car dealership valuation, and the discounted cash flow method. We'll then compare these valuations that we've found with the Autobahn offer of $160 million. And then finally, we'll walk through some potential strategies, including maintaining the status quo, partial management buyout, soliciting additional offers for the consolidated business, and lastly, soliciting offers for the European division. And then we'll summarize and recommend what we feel is the best strategic movement for Fastlane Inc. at this time. So currently the U.S. economy is recovering from a recession. This is increasing consumer confidence. Consumers are going out, and they're more confident in their future, in their employment, as unemployment continues to lower. And they're more likely to go out and buy new vehicles and step up to luxury vehicles, which, as we know, Fastlane Inc. Largely sells. Additionally, vehicles are aging. The average age of vehicles now on the road is 11 years. So as a result, more consumers are going to be going out and purchasing new vehicles sheerly out of necessity, needing to get from one place to the other. Additionally, credit terms have improved, interest rates are lower, and banks are making it easier and more readily available for consumers to attain these loans. And lastly, there are a large number of active buyers. Both private and public dealerships are looking to buy out additional dealerships, consolidate, and they're willing to pay large amounts for these. On the contrary, the European industry is looking rather bleak. Dealers and manufacturers both have overcapacity, causing them to lay off people, which is a common trend in the European market as unemployment is at record highs. This is also creating low consumer confidence. People are cutting back on discretionary spending, and they're actually downgrading sometimes from luxury vehicles down to more basic vehicles just to fit their needs. Additionally, the economy is projected to have slow or possibly even negative growth in the future. And again, consumers are going to be cutting back as they plan for their futures. And similar to the US, merger and acquisition activity is high as companies are looking to consolidate multiple dealerships under one roof, take advantage of synergies to reduce the costs. We selected three companies based on financial factors and financial results that we felt best compared to Fastlane Incorporated, and we took a median of those multiples based on the last 12 months financial data, and found a high and low range for that. And we also used a control premium, two control premiums, one of 24%, one of 26%, which we selected based on recent transactions. The 24% was at the low end of the control premium scale. 26%, while a little bit higher, it was still near the middle. And our final valuations were in the range of $140.5 million and $153 million. Then additionally, with this method, there are some special considerations. This method does not explicitly account for growth, capital intensity, and cost of capital like you would see in a discounted cash flow method. However, it is implicit and it is taken into account in this calculation. And additionally, these multiples do not reflect projected results going forward. We felt we put less weight on this method of our valuations because of this factor, because the economy is projected to go up in the U.S. and we're expecting large growth. And we felt that this EBITDA number for the last 12 months was relatively low compared to what it's going to be moving forward.
I have a question for you.
Yes.
Did you make any adjustments to EBITDA for kind of one-time add backs, one-time non-recurring events?
Yes, we added $1 million back to EBITDA for non-recurring expenses that occurred during the year. Now I'm going to pass it over to Kaushik, and he's going to talk about the blue sky methods and the discounted cash flow.
Like the EBITDA multiple method, the blue sky method uses past financials to project the equity value. So since we are coming out of a recession, the past year is a poor predictor of the future years. So we are getting a lower valuation. Like the multiples that we use, the lower end is valuing Fastlane at 103 million, and at the higher end around 108 million. We could have fixed the multiples and give it a higher one to compensate for the lower EBITDA, but we decided not to do that. Like we decided to present it with the minimum assumptions and to give a more realistic fee. The DCF, on the other hand, takes into account future cash flows and takes into account the future growth that can happen in the market. So as a result, you can see that our valuation increases. Like the lower end, on the lower end, we have 154 million to about 182 million. This method only is dependent on the terminal growth rate. We expect the US market to grow from 2015 onwards about 4% a year. So that would give the valuation close to the offer that we have on the table. And at the lower end, it's about 154 million. So this is a walkthrough from how we got our cash flow from the EBITDA. This chart basically summarizes the valuation methods we used. Like I said, the blue sky method and the EBITDA multiple method is giving us a lower valuation because of the poor, weak past results. But the DCF gives us a more or less correct range of the valuation of the company right now. And you can see the offer is at the low end of that valuation. Now Brad is going to walk you through our alternatives.
Thanks, Kaushik. So before we go through the specific alternatives that we looked at, I want to get into a little bit about how the company would look if you just really didn't do anything as a status quo going forward. And we can kind of use this as a comparative benchmark when we look at the alternatives. So continuing current operations without changing the structural management. And basically what would happen here is you'll have gains in the US market based on just the market trends, but it'll be pretty much offset by the downward trends in the European market. At the same time, you have fragmented divisions right now between the American and the European, and you're really not utilizing a lot of the synergies, the synergistic opportunities that we really feel there could be maybe with other companies, that sort of thing. And also, the current shareholders will not gain extra liquidity. A lot of the shareholders, as we understand, want a little bit of extra liquidity that they can use to diversify their assets a little bit more. So the three main alternatives we looked at were to increase management stake, solicit additional offers, and solicit offers for the European division. And I'm going to go into more detail about this now. So the offer to, or the alternative to increase management stake, basically what would happen here is that the company would take loans to utilize the low interest rates in the market right now, and the management would purchase shares from the existing owners and boost their stake of equity in the company. Now, the advantages to this, it will really satisfy the shareholders because this is kind of what they're looking for. They won't lose complete control in the company, but they will get extra liquidity. It also aligns management's interests better with the shareholders, and additionally, it's a fairly common and feasible alternative. The disadvantages are that it really does not address the European concerns. It also doesn't really address concerns about operations at all, and it really doesn't address the issue I talked about earlier about utilizing additional synergies. So now we look at solicit additional offers. Now here, what we would really have you do is we would help you go on a roadshow and have an initial exploratory review, in which we would go out with you and kind of look at what active interest there is in the company. What we would also do is have you set up a confidential memorandum where you can actually have interested buyers set this up for them. It would be basically a virtual data room, and they can use this to see more information about the company if they're interested. Now, the advantages of this are that it will offer a higher valuation because of the greater demand for the company, rather than just having one offer. It will also provide shareholders with the desired liquidity that they're looking for. The disadvantage is that we really feel that this is the least feasible option. It's going to take a lot of time, a lot of cost in the entire process. In addition, management really will not be satisfied with this option.
What kind of costs are you talking about with running an auction process like this? I understand the time, it's going to take time versus doing a one-off negotiated transaction, but.
Sure. Well, some of the costs include just the mere fact of time that's put in from that's not put into the company, not focused on the operations. That's just going out and trying to get these offers, spending time marketing the company, and that sort of thing. So.
Can you elaborate on the management dissatisfaction?
Sure. So basically, when you're looking at selling the company, a lot of times what's going to happen is, management's not going to be happy because they're not going to have a job after that acquisition, and so really that's not what they're looking for. They're not getting a lot out of this like the shareholders are. So,
is there any way to protect management in a kind of a strategic acquisition process to
sure.
get them comfortable that they've got to do the right thing in terms of presenting the company through a sale process because there is something for them at the end of the day?
Sure, and that's a definite possibility. We felt that that this is one of the reasons we looked at this, is because there are ways around that. It would just be an extra hurdle to work out, more or less, but there are certainly ways around that. So yeah, that's definitely something to look at. So the last alternative we looked at was to solicit offers for the European division. So rather than selling off the entire company, just selling off this division. Now, it would be similar to the last alternative, in which we would help you go through an initial exploratory review. What we would really be looking for here is buyers that can leverage the synergies with this company, and that will really increase the value of it. So again, we want to create a confidential memorandum. And the advantages of this are that you have, again, a higher valuation because of the greater demand. It'll also provide liquidity, and it's a smaller transaction. Yes?
That's your 5 minutes. That's all.
Oh, okay. It's also a smaller transaction, so it's easier to implement than the previous alternative. However, the disadvantage is obviously that you would lose that sales volume from overseas. So now, after looking a little bit more in depth at all these alternatives, I'm going to turn it over to Josh, who's going to do a comparison of these.
All right, good afternoon. So we put together a matrix to help illustrate more our process and our decision making here on which option to choose. And we looked at the status quo. We looked at the 3 options that Brad presented to you here: the increased management stake, solicit additional offers, and look for some offers from the European division. Now, the 4 criteria we used to rank these were: number 1, liquidity. How much cash does this get for you as a board? Shareholder acceptance. Are the shareholders going to be willing to accept this option and look at it? Also, how much value is created for the shareholders? That's the most important thing, we know. And finally, how easy is this option going to be to implement? So looking at the status quo, it's not really going to provide you a lot of extra cash. I mean, it's not providing a sale, we're not issuing anything. Shareholder acceptance, it's not really going to meet the goals of the shareholders. We know the 2 families are looking to diversify, and the 2 managers are looking for more stake in the company. This doesn't do any of that. As far as shareholder value, the same thing. It's not really creating any extra value right now, but it certainly is the easiest option, just to continue with how you're working. Increasing management stake, it will provide a little bit more liquidity. You're going to go out there, you're going to take some debt in the market. Shareholder acceptance, there are certainly several shareholders that are going to like this. You're going to get the two families that are going to have more money to diversify, absolutely, and your managers are going to take on more of a stake. Shareholder value, not a whole lot of creation there, but we think it would be reasonably easy to implement as well, just because of the low interest rates in the market right now. Now, if you go out there and solicit additional offers, I mean, it's about as liquid as it gets. You're going to get a big cash infusion, but you're not going to have much of a company left. Shareholder acceptance, it depends. We know we're at a low point in the market right now, so maybe we won't get as much value for the whole company as we should. And that goes into shareholder value as well. Now, as far as feasibility, we're not sure if this is entirely feasible because we know smaller transactions are more attractive in the market right now. This wouldn't be a terribly small transaction. So that takes us to our final, soliciting offers for the European division. It's going to provide a reasonable amount of liquidity. Shareholder acceptance, we think we're going to meet most of the goals of the shareholders. The families will get more liquidity for diversification. The managers will get more of a stake. It will also create some shareholder value, and we think it may be a little bit hard to implement, but we're going to walk you through how we can help you with that. And as you can see, soliciting offers for the European division is what we recommend to you, and this is how we'd like to help you do that. We see leveraging our relationships and connections in Europe, in Germany, and seeking out companies that have synergies where we can get more value out of the European division. We use 20% of the proceeds to buy back some stock from the Millers and the Johnsons. That'll give them that liquidity to diversify that they're looking for. And also this will inherently increase the equity stake for Mr. Bob. Now we know we have Mr. Schumacher in Germany, and what we recommend for you is offering him a position in California if he's willing. If not, then certainly draw up the contract so that he's protected in his interest in Europe. And then use the remaining proceeds. We think it's a great time for acquisitions in the California market where you can find more synergies. So the target sale price we would look at for the European division would be between 55 and 75 million. The support for that, we use primarily the discounted cash flow method. As we said, we think that's the best way to look at things. And we're going to look at the equity value right now between 43 and 51 million. But we also need to look at the synergies that we're going to get out of the cost savings of that 1.5 million. We think that'll add an additional 15 to 25 million to the value, which gets you up to that 55 to 75 million range. So just as a summary of our recommendation, again, this provides liquidity where it's needed, absolutely. Provides Mr. Bob with a greater equity stake, and it positions you for more strategic acquisitions within the marketplace. Acquisitions where you may find more synergies and more value in the California brand. So in closing, we would like to represent you guys in these transactions. We feel this is the appropriate course to take. If you have any other questions.
Is there any reason why you wouldn't just try to do a privately negotiated deal with Autobahn rather than take the company to market?
Yeah, we think there's a lot of churn in the marketplace in Europe right now, so we think there's potential to get more value than what Autobahn might be willing to provide. So going out in the open marketplace, we think there may be more opportunities. Now, like I said, we're not going to completely rule out Autobahn. If they're willing, then we'll.
Would you give them a shot, or would you say we're going to market and they would just be a participant?
We know what value range we want to get out of the company, so I think it would be reasonable to give them a shot. You have a ready and willing buyer here, based on the range.
Is there anything other than the status quo that could be done with the U.S. division, such as monetizing real estate or anything like that, just to get some additional liquidity for the shareholders?
I mean, monetizing the real estate would certainly be one option. We know now in the marketplace, since there's a little bit less demand as we're coming out of a recession, there is some excess real estate. I'm not sure if that'll provide as much liquidity as the Millers and the Johnsons are looking for, but that's an option, sure.
Okay.
Thank
Thank you.